Okay, very good morning. It is Tuesday the 16th of January. I hope you all made it through Blue Monday, officially the most depressing day of the year yesterday. Combination of the weather, debt levels and broken promises on New Year resolutions. But it looks as though this morning US indices didn't get the memo. We've printed fresh all-time highs again. We've busted 26,000 in the Dow Jones future, and we've seen the S&P 500 briefly break the 2800 handle as well. So we'll have a quick look at those charts first, and then we'll have a look at a few other things. There's a couple of headlines to cover off, and then we'll look at the calendar ahead with particular focus coming up in about an hour's time. We've got UK inflation figures, and we'll have a look what we're expecting from that as well. So kicking things off then, let's have a look at the charts and start with really this US equity move. This is the Dow here, if I just make this chart a little bigger. And as you can see, we've broken 26,000, which is providing a little bit of a barrier in the futures price action just as the early participants stepped in to the marketplace, and then we briefly popped higher above there. Looking slightly more longer dated though, obviously one of the most interesting things is, I mean, this chart here, I'll take you back to 25,000, and you'll remember 25,000 because it was only a couple of days ago. So we've gone from 25 to 26,000, and it's only taken since the 4th to the 16th of January to get to that price point. I did publish a poll on our Facebook community page. I'd be interested to hear your guys' thoughts about, you know, how high can this Dow go? What do you think the top is going to be? 27, 28, 29, 30, 30 plus? I'd be interested to hear what the consensus kind of view is on that, or even just pop them in the chat room. I'd be interested to know. But this incredible rise in US indices to kickstart the year has continued. Likewise, we saw the DAX follow suit. You can see here, if I break it down into a slightly shorter time frame, you can see yesterday top end of the range that was seen around yesterday's futures open. That was also around the same similar price point of resistance from Friday's session. We broke that. You can see the price shooting higher, some stops being run, only to then come all the way back down. And when you look at this on a minute chart in the DAX, it's a pretty spicy move. You've followed the US, really was the lead. We simultaneously broke a couple of key levels, round figures, 26,000 in the Dow, 6,800 in NASDAQ, 2,800 in the SPOOs, and the DAX just kind of followed suit, tripped those stops as I said, but then came racing back down in actually a more aggressive candle than that in which it rose. So I guess all this is telling you, if you are looking at things like the DAX instrument, obviously it's high degrees of volatility when the price moves like that. You've just got to be very prudent about booking trades, I think, and not sitting in something too long. Especially the DAX comparative to the US indices, where, okay, if you're already locked in the Dow, let's say it came back down and you've got in on that classic long now, then that's fine. You can probably hold on to some of that. You've got a pretty decent floor here to keep that long position on, with the resistance at that level found from overnight and also in the day prior. And so then maybe just scaling out of that to see how the US come in. But in the DAX, I think it pays to be a little bit more proactive in that sense. You can see here, DAX, just as I mentioned it, another little push, just breaking that the day's range so far since the futures open. So now the gap fills on, which would be a push back down. If we break pivot, it would be unsurprising to see a pretty quick gap fill down to that 13,190.5, if that, given the way that some of the price has moved in the last couple of minutes here. In terms of European actual equity news flow, there's not too much out there. Just looking across the board, a couple of the movers this morning, the biggest percentage changes, they're pretty small stocks. JD Sports up about 7%, Provident Financial on the flip side down 5%. BP, you might have picked up in the headlines this morning, they're taking another $1.7 billion charge on their Deepwater Horizon claim closure. Losses, though, in the oil giant pretty much mitigated by the fact that their charge is fully manageable in their existing financial framework. They've been taking hits on the Deepwater Horizon claims for a number of years now, so they do have a kind of reserves set aside for this type of thing. So although it is a negative, it hasn't been a big fall in their share price seen thus far. A few other things then from a news perspective I just want to have a quick catch up on. One was I was off the desk for yesterday afternoon, but I was looking at the euro at around 4 o'clock when I came in this morning, because you can see here quite an extension of a wick on that price point. A lot of you guys may have been in the market, but just to get you up to speed if you weren't, just if you may have left early due to the US holiday, you did have these comments. This is ECB's Hansen says bond purchases could end after September. The governing council member speaking in the Boysen Zeitung, which is the main German newspaper, sees no threat to inflation outlook from the euro appreciation as yet. Now, did see pretty quick pop in the actual euro currency at the time. You can see here, this is how German 10-year government bond yields reacted to that hawkish comment. We did pop higher quite aggressively. But the move here, you can see if you're looking at really bunds this morning, we've already retraced this yield spike, and the euro likewise is even lower now from where that initial move came. So let me just go back to here and we can have a look at the crib sheet for the central bank's hawks doves, and you'll see that if you're looking at the ECB, this is where Hansen sits. Hansen is the Estonian central banker, and he sits just one notch below the Überhawk Jens Weidmann of Germany. And so, if anything, it's unsurprising to hear that kind of commentary. Weidmann, if anything, has kind of pulled back a little bit of his hawkish rhetoric, given that he seems to be in some way looking to reposition himself to be a little bit more centrist, so that he could be an open candidate for the potential top job when Draghi's time comes and his term finishes to be the replacement. But Hansen's kind of taken the mainstay then as the most hawkish then. So unsurprising, and hence a fairly limited reaction in that sense in the euro currency and the yield move, but nonetheless quite interested to hear that kind of commentary coming through. Just quickly, as I mentioned in the DAX then, you've pretty much filled that gap. So as I was just suggesting, if we get through that pivot, we've had that run lower, kind of makes sense from just the normal flow of price movement when the market's gapped up at the open without really much in the way of new fundamental catalysts in that sense. A few other things to have a look at. I do believe Piers may have touched on this yesterday, but just get up to speed. We also talked about oil yesterday at a 3-year high. Kind of Iraq, one of the bigger producers behind that of Saudi, alongside Iran, have been singing from the same hymn sheet as the likes of UAE and other oil producing nations in saying that cuts are warranted and should continue. One thing though is that hedge funds, they've boosted their bullish WTI bets to their highest since 2006. This is according to the data that gets released on a weekly basis from the CFTC. Brent obviously closing Monday above $70 the first time in 3 years. One thing that we're looking at in Brent, Bloomberg just looking at a fib retracement line this from the big collapse in prices really that we saw when OPEC were trying to squeeze the shale market out of the industry, and that caused that big collapse through 2014 into the beginning of 2015 from what was in Brent trading around a 120 handle all the way down to kind of $50. And then in terms of the high to low, so 115 to the 2710 level, we're coming up to that fib at 71.40 at the moment. So worth just noting that a few people are looking at these things at the moment. Elsewhere, we are in earnings season. I think it's Citi that we're looking out for a bit later on today. Not that I think I'll be looking for Citi to cause any kind of initiation of renewed buying in that sense. I think at the moment, this market, particularly today, you've seen this before with US indices, when we get close to these psychological handles, the market tends, it's almost like a tractor beam for sentiment. We're that close, we see the test, the eventual break, some stops get run, and then we see a bit of a push on. From there forward, I think you've got to really wait until the US equity open to really see whether or not we see an extension of this break that we've had so far on those key levels. But one of the things is that what are traders watching during this season, this earnings season in Europe, because that will start to commence as well in the weeks ahead. And there's a couple of things that people are looking at. One thing is in terms of overall profit enthusiasm. Citigroup basically run a benchmark index, and they're looking at global earnings revisions index. And you can see the global one is distinctly higher than that of Europe, ex-UK, although it's still quite positive. It's probably due to the outperformance that the US is set to receive from the tax change. So fund managers are going to be looking closely at forward guidance, essentially, when it comes to US tax reforms. This is going to be one of the key areas to look out for in earnings season. How much net benefit do these firms get? Yeah, if you look at what the expectations are, JP Morgan, for instance, they say they see a 2 to 3% upside to 2018 profit estimates for European companies from lower US taxes. So obviously, Europe's going to benefit less than that of its US peers, as only about 20% of their revenue comes from the US. I guess this is an average figure. And they have a lower effective tax rate. And the positive impact is less priced in, according to JP. Other things are stronger euro. Obviously the euro, though it's a little, it's pared back a little bit this morning, we are up at a 123 handle, there or thereabouts, in terms of the euro-dollar currency pair. And so it'd be interesting to see whether or not this stronger euro is providing a bit of a drag for Europe's exporters, of which we know things like the DAX, for instance, with names like Siemens, but also car makers, automobiles, Daimler, BMW, Volkswagen. You know, the price of the euro does have quite an influential impact. And if you think about going forward, where a lot of the bank calls seemingly are now that the euro bias is for further gains, looking at 130 potentially on the upside amid this persistent dollar weakness, then it's going to be interesting as well to see how that guidance starts to affect the stronger euro on those European names in particular. So a few other things here. I did send this article out to you this morning, so maybe worthwhile just casting the eye over and having a read ahead of earnings season getting underway. A few other things. One is, what's the latest on Brexit? Well, you remember there was a couple of kind of more, I guess, pro-European politicians that were meeting with Barnier yesterday, the chap you can see in your picture. But the latest that the FT are reporting is that the EU has toughened up its conditions for a post-Brexit transition deal for the UK, demanding that Britain abide by stricter terms on immigration, external trade agreements and fishing rights for nearly 2 years after it leaves the bloc. So these are essentially revised directives drawn up by the chief EU negotiator, Michel Barnier. So Europe trying to take a bit of a tougher stance. Again, is this having a net immediate impact on the pound? Well, no, not this morning. Probably a byproduct of two things. For one, this is a bit of political positioning, I would say, going forward into a key period really in the next kind of 8 weeks before we get to that end of March trade talk EU summit. I think that's the 22nd, 23rd of March. But then also from a trading perspective, you've got UK inflation data looming in about 45 minutes. So maybe as well people preferring to just sit on the sidelines. Let's just wait for that key economic piece of data coming out of the UK, which will probably be quite influential for the price action for today specifically. But nonetheless, Europe talking tough at the moment. So the Brexit schedule is pretty busy actually this week. You've got that lower house hearing about Theresa May's Brexit legislation. That's happening today and tomorrow, and then that will look to make passage into the upper house. And so quite a few things to just keep in the back of your mind if you're looking at the pound. One thing though, looking at the major pairs this morning, if you think about it, the dollar has had a sequence of down days, and this morning your dollar index is actually up about 0.5%. Excuse me, 0.3%. So a bit of dollar strength coming in, and so you can see that just reflected really on both major pairs, just coming under a little bit of weight. Gold prices as well, with some of the dollar strength. I guess this pivot level would be an interesting target. First of all, you've got that low that was seen going back to Friday night. I guess this would have been really, well, Sunday reopening of electronic trade. That's pretty much where we've tested already this morning. Break of that will open up then probably next point of technical relevance down at pivot. 1333 was that cluster of price action activity we saw last week, midweek, amid then some of that price movement we saw back on the 12th, which would have been non-farm payrolls. Well, not non-farm payrolls, on the 12th here, sorry, I'm looking back on the 130 release, so I think that was the inflation data and the retail sales report, excuse me. Likewise though, with a bit of dollar strength, crude oil's just been drifting a little lower overnight, so with lower or crude backing off as to is gold, then maybe just keeping half an eye on some of those commodity-linked currencies as well. A few other things. One, almost with that push higher, what was quite interesting is equities, although that rally has abated now in the US futures, when that was happening, there was a really nice inverse relationship with Bitcoin. Let me just bring this into chart. Looking here at Bitcoin futures, taken a bit of a bounce here in the last 20 minutes or so, but we printed a low down at basically 11,500. So we've just fallen this morning. With the Dow and other US indices rallying, we fell from around a 13,000 handle all the way down to 11,500. So a cool 1,500 points just taken off the price. And that came in a period of about 20 minutes or so. But this does seem quite interesting, because obviously 2017 certainly finished with a flourish for the crypto space. But this ongoing kind of regulatory investigations, if you like, particularly coming out of China and South Korea, the latter being quite a big player in the crypto market, has seen some pretty interesting moves. And I just saw this kind of summary graphic. You can see here the run-up, particularly Ripple. I think the Amplify poll, when we asked you guys what do you think is going to be the story of 2018, I think a lot of people caught up in the whirlwind that was Ripple in the first couple of days of the year, and that has seen the most aggressive fall. It's fallen now over 50% of its value in a couple of days. But not only that, all of the others have also followed suit. And so it's just quite interesting to see how almost the market calm returning to this kind of fueling of that move that we were seeing in reality earlier just a couple of weeks ago. So interested to see how that fares. I would say, going back to Bitcoin, what is going to be absolutely key for Bitcoin in the near term, given the fact we just fell 1,500 in price just this morning. That's only 1,500 away from 10,000, and 10,000 is the big one, because so far, if you remember, the price got close to that a few weeks ago, but then bounced quite aggressively. You would think that a break of 10,000 though opens up then a serious run on the market back down to, I don't think things like 5,000 and below would be discounted in a very quick period of time. So definitely worth just keeping an eye on at the moment if you are looking at that type of product. Alright, quick look at the calendar, and let's have a look at what we've got on the agenda for today. And certainly one thing to remember, Martin Luther King Jr. Day holiday is over, so US market participants will be returning to the market in full, and so you can expect normal volumes to return. when we go into North American crossover in a couple of hours' time. In the interim period, of course, looking out for UK CPI. This is kind of the big one for the morning from a scheduled perspective. As you can see here, year on year, the headline figure expected at 3%. So this is what UK inflation looks like at the moment. And as you can see, 3.1% is the high. This is the highest inflation rate we've had in the UK since March of 2012. Now, the Bank of England seem pretty comfortable that this mainly has been inspired by the sharp depreciation of the pound. The question is, what is the more underlying inflationary conditions? Because as that EU referendum decrease in the price of pounds starts to phase out on a year-on-year perspective, then what are the underlying inflationary conditions, and do we start to see a pullback, or in fact do we remain elevated at this point or even higher, which I guess is probably the least expected, given the Bank of England seem fairly comfortable that this is around the top and that it will gradually return to target, which is why they have not hinted of any real need to increase interest rates again anytime soon. Remember, their current kind of forward guidance is that they're going to hike rates twice in 3 years. So until the end of 2020, there's only going to be 2 interest rate hikes, which is very slow in terms of a rate of normalization. But as I've said kind of many times before, I'm very much of the belief that this is probably the most dovish the Bank of England will be, given the fact that, let's say the baseline scenario is we have a soft Brexit and we secure a transitional deal. This should then come as relief, and confidence should return to the market, and so the pricing in of a rate hike should draw nearer rather than further away. So it's kind of how we're viewing things in the longer term. We did have a Bank of England MPC member speak last night at Queen Mary's University, Ten Reiru, one of the newer members. She said the UK economy will potentially have 2 more rate hikes over the next 3 years, so completely in line with their current statements. But inflation is key. Don't forget, 3%. We're looking at a pullback back to the September-October levels on a range. Always important to know the range, of course, when you're trading economic data. We got a low at 2.8 and a high of 3.2. So there are some slight outliers and a bit of a variance. So 2.8 would drop us back down to levels really since the summer of last year. And 3.2 obviously would be the highest going back in a couple of years. I would say, looking at the pound currency, a couple things. I would say if you get a 2.8% print, then definitely this lower bound of the range trade that was in play from yesterday overnight Asia Pac would be tested, 1.3756. But of course, you've got to be wary as well. What is the core number? You would need that to be equally weak and a miss on expectations to get down and test that lower bound of the range. On the flip side, I think really you need 3.2% to have a retest up at the overnight Asia Pac high in the futures at 138.33, which pretty much lines up 36 to the R1 and close within striking distance of that high from yesterday. So again, you're looking towards the upper and lower bound of the range, if not beyond. 3.3%, you're going to bust through that upside level. I've got no doubt about that. 3.3%. That's a bit of a game changer, and the Bank of England are going to start being a little bit nervous that they might need to take some preemptive action if inflation has really shot up like that. Not that I'm expecting it to do so, but then you'd be looking for the break of that upside level from yesterday in a potential classic long. On the flip side, if you get 2.7 or back to 2.6%, then we'll break that 37.56 most likely, and again classic short down to pivot would probably be a play there. But obviously the pound, we were looking at this yesterday, still got the chart marked up, and as we were looking at that really critical level, that 38.35, for the dual effect of it being the kind of February low pre-referendum 2016, but also the fib retracement of the high to low at the referendum itself down to the post-referendum low at around 120, and that level there is held thus far. That's a really important level. So irrespective of the data, at some point, if we do start knocking on the door of that 38.48 and we break, then that does open up a broader kind of medium-term push towards 140 would be, you would feel, inevitable from there forward. So the pound is quite interesting at around these levels at the moment. All right, other than inflation data, a few other things. Obviously, when you get CPI, you get the RPI and the PPI numbers. But again, when you get a big cluster of economic data like that, you've got to put it in order of priority. And the CPI definitely is the heavily weighted bias towards that measure that's going to move the price of the pound, and also indirectly the price of the FTSE, most likely. Looking further forward though, the rest of the day is pretty quiet. There's actually nothing major coming out of the States. Got one thing, the New York Fed manufacturing number we'll keep an eye on at 1:30, but very light. The main thing is, the day, I would say from a US perspective, is going to be driven by market sentiment, particularly with the breach of those aforementioned levels in the major US indices, and how much appetite our friends across the pond have got to really want to push this market any higher. Because fundamentally this morning, the reason for the break is there isn't really anything new fundamentally, other than the behavioral part of this market looking to test up at these record high levels. The narrative has not changed. Earnings season overall is expected to be pretty robust. Guidance is expected to be upgraded on the back of the tax reforms as well for a number of sectors. Global economic output is picking up, hence the reason why these equity valuations continue to be relatively one-dimensional to the upside for the time being. Okay guys, that's it. So I will wish you a good session ahead. Any questions, Sam and I on hand to help, excuse me. Okay guys, have a good one. Take care. Thank you.